All right, what do we do with the consumer packaged goods stocks in this new, more volatile environment? On the one hand, this group is traditionally seen as a safe haven in tough times. But on the other hand, the big worry here is about rising interest rates, which make bonds more attractive versus high-yielding dividend stocks, like, say, the consumer packaged goods plays. And now we also have to worry about commodity inflation. Take Clorox, the maker of household name brands like Glad Bags, Kingsford Charcoal, Hidden Valley Salad Dressing, Fresh Step Kitty Litters, Burt's Bees, and plain old Clorox Bleach, along with many other products. Clorox stock caught fire late last year, ultimately gaining 24% for 2017, but 2018, different story. Last Friday, Clorox reported a quarter that was widely viewed as a disappointment, missing numbers on both the top and bottom lines when you back out the tax benefits. Meanwhile, the gross margins came in lower than expected, and the company's seeing some troubling volume trends in the household division. In response, the stock got slammed, made even worse because of the market-wide sell-off. So could it be safe to circle back to this one, or do we need to be more cautious? Let's check in with Benno Dorer, the chairman and CEO of Clorox, to learn more about the quarter and where his company's headed. Mr. Dorer, welcome back to Mad Money.
Good to be back, Jim. Thank you.
Okay, but put it in context for us, because a lot of the analysts freak out as soon as the one that's never made a mistake has a couple of fault lines. How much of what the analysts who talk about margin problems, pricing troubles persist, how much of what are they looking at is fleeting, and how much are they looking at of things that you're actually worried about that could be longer term?
So the cost environment is difficult. It's difficult for everybody in our industry. We are seeing commodities rise, which is a temporary phenomenon as a result of the hurricanes that we saw last year. And we're seeing transportation costs rise, which is why we have to put our cost savings machine, which is a very well-oiled machine, back to work. But sometimes when you have a noisy time, and clearly it's noisy for everybody in the industry right now, it's perhaps important to understand what really matters. And what really matters for us is that we have a strategy that allows us to win with consumers and customers, and a strategy that we have a lot of confidence in. And that's because we are gaining access to new households. We are innovating in an environment where there's not much innovation around. We are engaging consumers online, and we're winning that battle for the consumer as she migrates online. And we are generally just in a very good shape as a company. And if you think about the first half for our company, that was a solid first half. And now, of course, we have the opportunity to put tax reform to work, which is going to be a huge benefit for Clorox shareholders. So all in all, at Clorox, we're staying focused on the long term, and we're staying the course because we have confidence in our path forward.
Now, there are analysts who want very much for you to lever up. Some analysts want you to give a special dividend. Some people want you to raise the dividend. Okay, I'm coming from another universe. I want you to find more probiotic-like acquisitions, because I feel like you're a machine that takes a property, runs it through the Clorox machine, and sales do great. Which is the best way to use your capital?
Yeah, certainly, the probiotics acquisition with Renew Life that you mentioned continues to do very well for us, and is on target and has grown double-digit last quarter. But our goal is to put tax reform to work, to make our company stronger, and to put excess cash into the hands of our shareholder, because we have no incentive whatsoever to hoard cash. Making our company stronger will mean that we will put strategic investments in place in the growth and cost savings of our programs of our company. And M&A certainly is something that we continue to be interested in, and we look at a lot of things all year long. We're looking at good businesses that are on strategy, that are profitable, that are growing, and importantly, good businesses that are also good deals. But, we do have more cash on hand now that we can put into the shareholders' hands, and we are working with our board to look at a variety of alternatives, and looking at the dividend is certainly something that we will do very hard.
Well, to me, when you look at rising transportation costs, which I think will ultimately be fleeting, when you look at the margin pressure from resin versus what you just said about what you're going to do with your cash, I find hard-pressed that anyone would sell Clorox. And instead, if you wanted something in this segment, you're the only one that I know that actually has that optionality. I mean, it's quite different from the other companies.
Yeah, we are a North American-based company, so 83% of our business is here in the U.S., so we are disproportionately benefiting from tax reform. For perspective, Jim, our suggested tax rate for this fiscal year prior to tax reform was going to be in the 32 to 33% range. Now we estimate it to be post-tax reform in the 23 to 24% range. That is a dramatic benefit, and like I said, we will put that money to work for our shareholders and to make our business stronger.
Well, look, I've been a fan of the story for a very long time, and for everything that you've done, I think this is the opportunity people are looking for. I want to thank Benno Dorer, Chairman and CEO of Clorox, for explaining exactly what's going right before people keep selling it because of some resin issue. Thank you so much, Benno. That's Benno Dorer. He's the Chairman and CEO of the Clorox Company. Stick with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.